Hey everyone, welcome to another video. And this video we'll be looking at roller coasters? No, I think it's stocks and stock valuation. We'll begin specifically just explaining some of the basic characteristics of a common stock, and then we'll discuss where it's traded both on the primary and secondary market. So what really is a common stock? Well, it's basically when a company tries to raise funds, okay, so they want to be able to finance their operations, and they offer shares, they offer ownership of their company to the public. So with shareholders, that gives them an opportunity to really invest in future cash flows. As the company does better, then the value of those shares will increase, and that will be beneficial for the shareholders. Shareholders also have ownership of the actual company itself, and we'll speak more about that in a moment. When we compare shares to bonds, it's a little different because there isn't actually no maturity date, and a lot more sort of volatility in terms of what kind of income you can expect. Okay, so it's not a fixed income like a bond is, very variable, really depending a lot on buying and selling the stock. So ownership, again, we do have ownership of the company, and other types of ownership is the idea of residual profits. So when we talk about residual, the reason why it's residual perhaps is because we first have to pay, or the company first has to pay all of its creditors, employers, basically all its liabilities first. Then finally, the owners or the shareholders have access or are entitled to whatever profits are left over. Okay, so this is what we mean by residual profits. Shareholders also have voting rights. So what that means is that they have an opportunity to really, play an influence in the management of the company. Particularly, they have the opportunity to elect the board of directors, which has, again, a lot of influence in how the company is operating. Going back to the idea of a residual claim, again, same idea even in the case of liquidation. So if a company goes bankrupt perhaps and they have to liquidate all their assets, they will have some sort of residual claims or assets in terms of the cash flow of the asset. But again, we have to remember that they have to make sure that the lenders or the liabilities are paid for. So really, they're really on the lowest priority when it comes to receiving any of the benefits. Okay, so this is what we mean by residual rights. Now, the upside of this is that unlike bonds where they might get paid first, the upside for shareholders is that there is more earning potential. So start thinking about that in terms of reward and risk. Okay, and we'll talk more about that in a later chapter. So voting rights. What does this mean? Well, most times when you purchase a share, you basically have one vote per share. So that gives you, a quite fair representation in terms of voting rights. However, this can be altered by the company. Okay, and we can do this in certain ways. So really the way that we do it is issuing out different types of stocks or different classes of stock. So first is actually issuing non-voting stock. So if you think about it, if you issue out non-voting stock, well, that means those that have shareholders, those that have stocks that are able to vote, that vote one per share increases. Okay, so that's one way to sort of influence the increase in influence in terms of the votes that are already provided by the common shareholders. Now, another way to do it is instead of making those votes more valuable is you can actually issue shares that have super voting rights. Okay, so these are, again, a different class of stock, but now they actually have more voting rights than our usual common stock. So in this case, you would have multiple votes per share. Okay, so this obviously would increase that influence over the company. And this can be super important, particularly for those that want to make sure that they have a significant amount of ownership for the company. Reminder again, with common shares, there is no maturity date. And because of this, we consider it a form of permanent financing. Again, if you recall the bond is really just a loan that the company gets, but it's expected to pay back at that maturity date. And when we're looking at stocks, we're not actually loaning out that money. We're investing in that company. So that's really the difference. And in terms of how long we keep that stock, well, there's no really set date or maturity date. So with that in mind, this also means that you may not actually receive an income. It really just depends on when you actually sell the stock. That's when you actually receive that income, and that's really not up to the company in any way. So there's no real guarantee or promissory date in regards to when you'll actually receive an income. However, speaking of income, there is something called dividends, and basically these are cash payments that are paid periodically, usually every quarter. Now, not all companies pay out dividends, but this is one way to attract shareholders, one way to sort of reward them. This is maybe the closest thing to some sort of income that you would receive. Now, in terms of tax, there's some differences. So if you recall, when we looked at our income statement, I'm sure you'll remember that the interest expense was tax deductible for a company. So that is tax deductible for a company. However, dividends are not. So dividends are still considered a taxable expense when that's from the company's point of view. From the actual recipient, or the one receiving the dividends, so the investor, they are also considered taxable income. So they're not tax deductible, but this is a U.S. Sort of law. Good news, in Canada, the dividends can actually be considered tax deductible. So that's some great news for us Canadians out there. Let's talk a little bit about shares themselves and how they're issued, right? So in order to issue shares, they have to be authorized. So authorization usually the government has to be involved at some point. But basically the idea is you need to have first a number of shares have to be authorized, and then they can actually be issued. And there's two ways they can be issued. So first, you would issue them, to the public, and that's sort of what we expect when we think about outstanding shares, right? But there's also shares can be issued basically by the company and kept by the company, and this would be considered treasury stock. So this is something that they might want to keep for themselves. A little bit more about treasury stock. The difference between treasury stock and a common stock, one major difference, other than the fact that it doesn't pay dividends, is that there is no voting associated with these shares. So they don't influence control or decision making with the company. So that's important to note. So when we do have or give out treasury stock, we can initially, the company can decide to actually reserve a number of stock or treasury stock for themselves, but they can also decide to repurchase some stock later on. But again, what's really important in both cases is that they do not have voting rights. And this is important because that means a company can't really own itself. So that keeps it from, by being continuing to allow it to be public and be a little bit more objective. Rights. Now you do have some rights as a shareholder, and probably one of the biggest privileges is the idea to be able to purchase stocks before it's actually issued to the public. So why is this helpful? Well, imagine if you own 10% of a company. So you own 10% worth of shares. Now you are very happy with the fact that you own 10%. And what would happen if the company issued out more shares? Well, if a company issued out more shares and the public purchased those shares, then you would lose that proportional ownership, right? You would no longer own 10% of the company. So this preemptive right gives you the opportunity to purchase those shares first, at least enough that you would maintain that proportional ownership. So in other words, you get the opportunity to continue having that 10% ownership. And this is what we mean by a preemptive right. So it's really the right to the first buying of stock before it's given out or offered to the public. So that's a little bit about stocks. Now, where are these stocks traded? Well, there's two markets that we need to consider. First is the primary market, or the first sale. And then the more common, where most of the trading happens, is the secondary, or the after sale market. So what do we mean by the primary market? Well, perhaps you might have heard when companies go public. This is basically what this means is a privately traded company is going to become public, and they're going to collect or complete an IPO, or an initial public offering. Okay. Now, in order to do such a process, it does take a lot of expertise, and most companies don't really have that expertise. So what they do is they hire an investment banker, and they will create a prospectus. Okay. And really, the prospectus is basically provides the potential buyers information about the company, about the upcoming sale, anything that's required. Okay. Also, they'll do some due diligence, make sure that they disclose any information that's needed to be disclosed. Right. Now, how this investment banker is compensated can go about in two different ways. First, the investment banker could actually make a firm commitment, which basically means they would buy the entire stocks that are issued, okay, and then they would sell those stocks at a higher price. Okay, so this is good for the company because it's pretty much guaranteed capital, right? Because the investment banker is going to purchase that equity, and for the company, that means that we have some guaranteed money coming in. So that's one scenario. The second scenario is that we can use a best efforts sale. Now, this case, the investment banker isn't buying everything. He's actually not really buying there's no real commitment. Basically, what is attached to the sale is a commission-based sale. Okay, so when the shares are sold, he or she would receive a commission. Okay, and really, we call it the best efforts because there's a pledge that they would do their best to sell as much shares as possible. And of course, there's still incentive for them because it's based off of a commission. Okay, so in both cases, once the IPO is made, then the stock will become traded on the secondary market. So this is what we're more familiar with. Usually when we talk about the stock market, we're really referring to the secondary market. Okay, this is where stocks are traded. And, again, going with reference to US, the NASDAQ, the NASDAQ is an example of a really specific type of industry, specifically focusing on tech. Okay, New York Stock Exchange, NYSE, or the TSX is what we would have similar, which is the Toronto Stock Exchange. It's a Canadian version. Okay, now there are what's called specialists, but honestly, they're not as common as previous, basically because there's a lot of electronic trading going on. But really, the job of a specialist is to sort of coordinate and maintain order in the market. So they're coordinating between those selling and buying. Okay, so we have the asking price, which is really figuring out, what the sellers are willing to sell their stock, and we have the bid price, which is when the investors are willing to buy the stock. Okay, so typically or originally, the specialists would be responsible for that, and they would basically make money based off of the spread between the difference between the ask and the bid price. Okay, and that's what we mean basically by the bid-ask spread. Now, in terms of the different types of markets that you might be referred to, so first we have what's called as a bull market. Okay, and this basically just means this is when the market is doing well. Okay, and the reason why it's considered a bull market, again, if you take a look at our incredible view here, we can see that not just that the bull is going upward on the roller coaster, but really the idea of the bull market is that as a bull attacks, they go from the bottom to the top. Okay, so in other words, it's going upward. That's what we mean by bull market. It's a strong market. There's confidence. We also have what's considered a bear market. Okay, so this is considered declining, and again, we have the the poor bear going down the roller coaster of the market. But again, based off of the way that a bear attacks, they kind of swipe from top to down. Okay, so this is what we mean by declining market. So very visual way to remember the difference between a bull market and a bear market. Okay, so just a little terminology there finish things off. Wonderful work. So we'll continue our discussion of the stock market. Again, we just talked about some basic characteristics of common stock and then the two separate markets where they are traded. Thanks for watching and happy financing.